evening, everyone. We are back this evening. I'm Sansum and Ask Amarel. We are continuing our wealth series. And I know that last week we promised that we would be talking about investing and retirement. We had just a little glitch with our, with just connecting with our person. So we are going to push that to next week. We're not going to leave you hanging. We are absolutely, it's information that the community absolutely needs. And we ourselves are excited about getting the information. So we are going to reschedule that for next week. But we have an equally important topic that I'm actually kind of glad that we had this window and had this opportunity to actually plug it in, because I think I have more conversations with people on a regular basis about this particular topic than maybe anything else outside of credit. So it actually is providence that it worked out that we have a slot in our series. And tonight we are going to talk about mortgages. We're going to talk about all of the sides of real estate financing, of especially residential financing, financing for your home. It's one of those things that many of us, most of us either are involved in or are aspiring to actually purchase a home, but oftentimes we know very little. We know very little about how to get started. We know very little about how to prepare for it, or even once you have a mortgage, what those responsibilities are and what that looks like. So we're actually super excited that we do have the opportunity tonight to share a little bit of information with you on this particular subject. And as I've probably shared on here, but I often share all the time, is that I'm a connoisseur of random facts. So one of the reasons that I'm Ask Amarel is that I pick up knowledge from different places. So my friends quite often will have a thought about, I wonder if I can do this. And literally I've had the conversation where they're like, oh, I'm just gonna ask Amarel. But that does not make me the expert on all things. And on a subject as important as this, Sansum wanted to make sure to not just bring you tidbits of information that Amarel could definitely do, but we wanted to bring you an expert. We wanted to bring you someone who is in the trenches, who's helping the community with their mortgage needs, and who deals with this on a day-to-day basis, and who can definitely lend expert hands-on experience on the mortgage lending process. So with that, we called our friend Nadia, and she was gracious enough to jump in and say, absolutely, which I love. I love that the energy was, yes, I absolutely want to talk to the people about this particular subject. So we're bringing you this evening, Nadia Al-Cid, and Nadia is with, I want to get it right, Nadia is with the Mortgage Biz Florida, which is a mortgage company in the area. And I'm going to give Nadia the opportunity to introduce herself. Tell us a little bit about you, Nadia, a little bit about the company that you're with, and a little bit about possibly how you came to find yourself seated here as our mortgage expert tonight. How did you come to mortgages?
All right, so as Amarel said, and thank you so much for having me this evening, I really appreciate it. This is a passion of mine, sharing my knowledge with the community and letting everybody know, hey, what I know isn't so secret, but it's the keys to a lot of, building our wealth. So I was born and raised in South Florida. I've always actually been involved in the real estate community coming up as a child, worked in my family's mortgage business, and went on calls with my grandmother, who was also a realtor. So the mortgage and the real estate business has always been a part of my lifeblood here in South Florida. Because I was so exposed to it, I actually said, I don't think I want to do this business. And I did some other stuff before, and then this just became my calling because I just love it so much, and I'm able to explain what it is that I do, such an important process, at least in somebody's life, like one time, maybe multiple times, for me to explain it in a way that's simple enough for you to get it. Because for me, transparency is very important in this process. And that's really in a nutshell about me. I mean, if there's any University of Florida graduates, I'm a University of Florida graduate, so go Gators. But yeah, that's me in a nutshell.
I appreciate that. And I love how University of Florida is going to get a Go Gators in there.
Yeah, we got to put it in.
Our president is a University of Florida graduate, so we get to Go Gators all the time.
Yes.
I appreciate that you came up, that you're as a family, that you came up in the industry and then find yourself sometimes when we're so familiar with it, we run in another direction, but yet because it's a passion, get pulled right back in. So I'm super glad that you did follow that passion and that you are here sharing with us. Hold on, I dropped my notes real quick. So I wanted to start with just telling us a little bit about, in your experience, we are in South Florida, so I will give South Florida the first look as to what you have found in the South Florida community, mortgage-wise, financing-wise, both opportunities and challenges that may uniquely be either opportunities that are uniquely found in South Florida, or perhaps challenges that you run into that may be unique to our area.
Yeah, so I'll start with the challenges. I would say sometimes the income doesn't really match the amount that the houses cost, right? So there lies a little bit of frustration with some of my clients where, yes, everybody's working hard and super commendable, and I can speak to that, but sometimes the housing prices do not match that income. And so that's probably the largest challenge, I would say. And then another challenge would be some people aren't in control of their debts, if you will. So that's something that's like very important, where I know we want to keep up with the Joneses here. It's like a South Florida lifestyle, just be honest. And I do tend to see sometimes, a significant amount of debt, which maybe is necessary, maybe potentially not. But those are some of the things that I see as the challenge in the South Florida area. And another challenge that I'll bring up is sometimes the houses are a little bit older. So yes, they're a new construction, but sometimes the homes are a little bit older. And so there usually are two different products that we'll use for the typical consumer, which is a conventional or an FHA loan. And so sometimes the challenge is it may be harder to get somebody into an FHA loan if the property is older. We can like delve into that. I feel like I'm maybe getting ahead of myself here. That's like way into further detail. But I will say one of the things that I see here that's like super positive, people are determined, right? And so if they end up working with the right professionals, they're very determined to purchase their home, purchase their property, and make it to the finish line of closing.
Appreciate that. You mentioned income being one of the challenges. On average, and we'll delve into some more unique and specific, some specific situations, specific needs a little bit later. But on average, let's say average middle class person, what are you looking for in income? Not as far as amount wise. I think I'm looking more for you to share what are we looking for when we say income or verification of income. What are we looking for? I'm thinking length of time. I think those type of things. What are we looking for when we say income?
Yeah, so when we say income, I'm looking for at least 2 years of verifiable income. For something like an FHA loan, 1 year of schooling is considered verifiable work experience. So I need at least 2 years.
Let me make sure I get that. So yeah. 1 year schooling. So if so 1 year out of school and working in my field, is that what I'm hearing? Can count as my 2 years?
Yes. So say if you go to I'll just put nursing school. Like say if you're in nursing school 2019, and that's what you were doing. 2020, you have a job at the hospital. That is considered your second year of work experience.
I like that. So work experience also, one of the things that I get this question, and I'll preface by saying that for those who may not know that I am a realtor in real life, and one of the things that happens quite often is that, especially when I meet brand new clients or people who are new to the process, is that they will come to me with those questions. What should I do? How much income do I need? How much money? And I often have to share and educate and enlighten people that I do not control the money. I have no say so in how you obtain the money. So as realtors, we help you find the property and navigate through the process of buying that property. But it is Nadia, it is the mortgage broker who actually answers all of those, how much money do I need? What kind of payment am I going to have to make kind of questions. So I just thought that it was an opportunity to plug that in there. You're going back to verifiable income. When you say verifiable, can you give me some examples of what is considered verifiable? I think Nadia might be frozen for, okay, I think she's frozen for a little bit. Hopefully, okay, there you are.
I'm back. this technology, but it's all good.
Verifiable income. What is a mortgage lender looking for when they say verifiable income?
Yeah, so making sure, so you don't necessarily have to have a W-2, which is for someone who's not self-employed, right? So you go and work for somebody, like you're working at Target or something, you would receive what's called a W-2 at the end of the year before you file your taxes, right? Or somebody who has verifiable income in the form of a 1099, so they may be an independent contractor with someone, or they're working freelance, or somebody who's self-employed where I can actually see it on their tax return. If I can't see the income, like say somebody paid you, say under the table, some cash and you didn't claim it, then that's not verifiable income to me. I won't be able to use that anywhere on your transaction with verifying the income to be able to afford your mortgage.
Got you. So verifiable means we can verify it and where it came from.
Yes. There's at least a paper trail somewhere.
Somewhere. We're in South Florida, and God bless us, we definitely have a lot of entrepreneurs, which is a beautiful thing, which is a great thing. I think our community has an entrepreneurial spirit.
Yep.
Okay. Sorry, we're muted for a sec. It's just a matter of being able to actually, when you want to do the things that you want to do, being able to do them, because we've taken the time to actually figure out how to make sure that we are checking off those boxes of those things that are important, like having our income verified. So, okay, so anything else on income that we need to be mindful of? If I'm thinking about buying my first home, and I am either self-employed or working for a company, I've been there, I can fit in my 2 years and be able to prove that I've been on this particular job for 2 years. Where do we go after income?
So I do break it out into 3 tiers, and I'll just tell you my 3 tiers. This is usually happening when I'm talking to somebody over the phone. So we are talking about income, right? And so the next place that I really talk about with income, that's just like making sure you show me everything, where that could be in the form of the W-2, the 1099, or your tax returns, right? But then the second tier is your assets, right? So I really want to know what you have saved in the form of gift funds or in the form of retirement savings, if you're going to use that towards your home buying process, or what you have saved in your savings account, whether it's like a high yield savings account or however you save your money. It just can't be underneath the pillow. No mattress money, you know. I gotta verify that too.
I think I heard you say gifts. So yes. No mattress money, but I can receive a gift. Is there a limit as to who I can receive a gift from? Does it have to be a relative? Can my best friend Sandra give me some gift money to buy my home?
Yes and no. So like, yes, she can give you money as a friend, but it has to be under a certain loan product. So your close friend can't give you a gift if you're going conventional, but your best friend or your close friend can give you a gift if you're doing FHA.
Okay. I want to, when we get down the line, I don't want to miss this point. I would love a great breakdown, and I'm looking down because I'm actually writing myself a note so I don't forget to go back to it. I'd love a great breakdown on, we're not going to do it now, but the difference between FHA and conventional, and why I would choose to go one as opposed to the other. Okay, so I can get a gift if I have my own funds that are saved. They need to be, again, and I harp on these words because these are challenges that I face on a regular basis. So it may seem very third grade, very elementary to those that are watching us, but I'm going to ask you again. Verifiable. Let me come to verify. We did verifiable income, verifiable funds, assets. What is verifiable?
All right,
What are you
so
looking
I will tell you first, like from the bird's eye view, I'm looking at a 60-day snapshot of your bank statement, right? So June, July, I'm looking at 60 days worth of your bank statement. And what I want to see in there is that you haven't made any egregious deposits that don't match your income or the typical monthly deposits that you're going to make. If you may have made a deposit before those 2 months snapshot, hey, I don't know, I don't see that. I only can see what's there in front of me within that 60 days. So within that 60 days, I can't see any large deposits. If I do happen to see a large deposit, it needs to have a paper trail for me to say, all right, I know it came from here. So for example, I've had a few clients that received the money, the COVID money, and it won't, sometimes if they didn't get the direct deposit, it won't say IRS, it'll say like e-deposit or something. I have to say to them, hey, this is not a customary deposit. Can you show me the canceled check, or can you tell me exactly where this money came from? Non-verifiable funds are if you take a large sum of money. So like sometimes we do susu or eso, or Jamaicans call it pardna. So all of that, where we're, putting the money in monthly, and then you get the lump sum whenever it's your turn. I can't use that because it's cash, right? And it's a large sum of money that we can't verify in any paper trail, unless that's maybe a best friend of yours, but I can't verify it if it's coming from cash. Go ahead.
So our partner Gil is on with us, and Gil has a question for us.
So I have a question. This is good because as you mentioned, the ISO or the SUSU, which is very common in Caribbean, African communities, people save for, they might get 20 people involved and have a lump sum, I don't know, let's say 40,000 or whatever amount it is. So what I'm hearing, and I just want to clarify for our community out there, is that they would not be able to apply said monies to the purchase of their home. Is that correct?
No, because I can't verify it if it's not coming through a way of a paper trail. So if I can't.
So how long? So let's say that, Marianne has her money, she's been waiting, she takes it and she puts it in the bank, and it's now there for a year and a half, for example. Is she still in the same boat? Or now, because it's been sitting for so long, is are they able to now apply it to their purchase of a home?
So yes, she can apply it, because remember, I'm only looking at 60 days worth of, that's all I see, nothing before.
So if you are saving up with your partner Han, then your plans need to be further down the line for your purchase. For once it's been seasoned and sitting in the bank, it won't impact your mortgage.
Exactly.
Okay, got it. Good to know, because we need to know information that's specific to our community, because a lot of people are working very hard and really sacrificing to put their money into their susu or their iso, and then come to you and say, hey, I'm picking up my hand next week, I'll have it for you whenever we're ready, and you're like,
Yeah.
I appreciate that. Okay, so we did income, we did income, we did assets.
Yes. And the reason why I'm looking at assets, and we'll come back to this too, because I know we talked about this offline, it's for your down payment and closing costs. That's why I'm looking at it, to make sure you have enough cash to close on your transaction. And we can go into further detail about what that means. And then the third tier is your liabilities or your debts, right? So that's when I go to look at your credit report and I assess what's on there. I'm not just only looking at the credit score. The credit score does have a large bearing on what your interest rate will be, but also your whole credit profile allows me to know if you're going to be considered a risk going forward. And so I look for things like, hey, was there any delinquencies recently? Or, hey, are there any collections and charge-offs? Will that mess with what's called our debt to income ratio? And the debt to income ratio is the difference between what you make in income compared to your debts, and seeing if you're able to afford the new monthly payment that you're adding to your debt in the form of your mortgage payment, to see if you'll be able to afford that. And so we're held to a certain percentage depending on what loan product you qualify for. So for FHA, you can go higher than 50%, depending on your credit score. For conventional, you can go, depending on your credit score, up to 45%, or if your credit score is above 640, then you can go up to 50%. So it depends, and I will tell you why it depends based on your credit profile, based on your income, and we run something called an automated underwriting. And so that tells us, and it's automated, we put in all the information, your income, your assets, and your liabilities, and it'll shoot back to us and say, all right, cool, we can proceed and move forward because they don't have as much risk, and we can move forward through the process.
Okay, debt to income. What kind of debt is calculated to my debt to income? So I have my cell phone, I have my water bill at the house, I have my cable bill, and of course, so what actually is calculated when you are considering my debt to income numbers?
So I'm only calculating what's listed on the credit report. So that would be like a car payment, student loans, if you have another property, credit cards, other installment loans. I don't look at what you would pay for a water bill. I don't look at what you would pay for a phone bill. But when I'm talking to my clients, I do ask them, hey, what is your budget? Because I know that there's things that I'm not seeing on the credit report that you may have to pay for. So you truly know how much you want to spend based on your obligations.
So once you have all this information, you mentioned credit briefly, and we talked about credit last week, so we're not going to harp on it a whole lot. If there are questions specific to our mortgage expert about credit, drop them in the chat, and Gil will be happy to share those with us. But otherwise, we're not going to harp on credit too much because we did that last week. So we'll go on to just a few other points that I want to make sure that we have an opportunity to touch. You mentioned briefly items of debt such as student loans. How do student loans impact my ability to purchase a home or to qualify for a mortgage?
Can you hear me?
There you are.
Yes, sorry. So student loans can impact your debt to income ratio somewhat greatly depending on how much you have in student loans. However, there are ways around it within our guidelines depending on what type of loan you qualify for. So if you're ready for me to go into deep detail about that, I can right now, because that is a passion of mine, going into deep detail about student loans, because a great majority of us who have gone to school maybe have student loans. And
yeah, we're already here. Please jump in.
Right, cool. So I'm going to start with the conventional option, right? So there's two, let me explain. So there's two investors of conventional loans. That's Freddie and Fannie, right? So Freddie will allow for us to use 0.5% of what the full loan amount is if I don't see anything on the credit report. So a lot of the times when I'm looking at somebody's credit report, I will see like $10,000 in student loans as the balance, right? But I don't see anything as a payment, because either they're deferred or they're on a payment plan where you just don't see anything in there. And I mean nothing. I don't mean zero. I just like blank. So I have to use 0.5% of whatever that balance is. So 0.5% of the 10,000 is what I will use as your monthly payment. For Fannie, I can use 1% of what I see over there as the balance. And so as you can see, the amount that I use that's higher, that takes up or that eats up more of your debt to income ratio pizza pie, right? So I try to opt for the smaller amount. The best workaround actually for a conventional loan is if you can get yourself into a repayment plan, an income-based repayment plan. Because if you're able to get yourself into an income-based repayment plan, and I get a special document that shows me, all right, here's how much you're actually paying per month. So say you're like, all right, I worked it out with Nelnet, I'm paying $28.15 a month. That's the amount that I get to use per month, which will obviously be like way less than the 5% or the 1% of the loan amount. So that's my little workaround for conventional loans. For FHA, it's a little bit more difficult. They do want you to use the larger of the amount of $0, $10, or 1% of the loan. And so usually it's 1% of the loan, especially if I don't see any payment in there when it's blank. I have to use 1% of the full balance amount. And I will explain that sometimes I do come up with a little bit of issue because I do notice where sometimes my borrowers will be FHA candidates, right? They're supposed to, like, you know, based on their credit, based on their profile, they're FHA candidates, but then the student loan comes in and it's more difficult to qualify with the higher debt to income ratio because of their student loans. So I
Now,
do
you ask during the process, during the interview process, let's say it's not showing up, do you ask whether they're student loans, whether they have student loans out there?
Yes, I do ask if they have student loans out there. If it's not, you mean if it's not showing up on their credit report?
If it's not showing up on their credit report, like, do you still have to figure it? Okay, so if it's not showing up, then there's nothing to be said about it. But if it is showing up, this is what your workaround. Would you suggest, one of the things that you just said was if a student makes a payment arrangement with their lender, that you would use that. If my plan to purchase is further down the line, let's say I have a couple of months ahead of me, I'm not necessarily trying to buy right this very second, would you advise going to your student loan company, and if you didn't have a payment arrangement already in place, would you advise going back to them and trying to get a payment arrangement put in place?
Yes,
Have you seen?
I've seen that happen because you do want that payment amount to show up on your credit report. So you know it takes that certain amount of time, that 30 days cycle, for it to show up on your credit report. So I would more than likely want to see it on your credit report versus getting that document in mid-transaction while you're trying to get pre-approved, because it's way easier for me to just use what's listed on the credit report versus
Got it. Got it.
I
So as
hate
much as possible,
but it's yeah.
So as much as possible, starting, if you're thinking about purchasing and you know that you're going to need to finance, it's helpful to get started on these things early. How early do you suggest that someone come and speak to you if they're thinking about purchasing? Let's say I'm thinking about it. I'm thinking, where are we now? We're in July, August, and I'm thinking next spring I want to purchase a house. Is it too early to start talking to you?
You can, no, I never think it's too early. I appreciate people who want to be prepared because sometimes the process can be a wild ride. But I also don't want you to overthink the process either, because that's why Amaral and me are in place to do the things that we do. But as a matter of like preparation and knowing what you need to do and what you might not know that's on your credit, I will say, like, hey, the earlier you can look at things and the earlier you can fix and update things so you don't feel crunched is a good look. Gail?
Thank you. I wanted to just 1 second and ask really quickly, well, it's a two-part question. What is one thing that we should be asking our mortgage brokers that we don't know to ask? And the second thing is, what actually, how are we picking, right? There's like 10 million mortgage brokers. So Nadia, I'll see the wonderful mortgage broker aside. How do we pick? How do we know who to go with?
Yeah.
And especially, I guess, in a world where your loan might start in one place and, be transferred to 10 different places over the course of the life of it. So I guess I asked a lot of questions. I apologize.
No,
Oh,
it's
really?
cool. I'm just trying to think, wow, you're like stumping me on like what is something that everybody should know. I just feel like, from our conversation, especially with the credit, I think it's so important that we know where we stand regarding our credit profile and our credit situation, because I have pulled credit numerous times, and some of my clients like don't realize that something's on there, and we're like right up to the edge, and I'm like, oh, I can help you to try to rescore this, but it's like very, choppy here. So I think that's probably the biggest thing that they should ask, like, hey, should I pull my credit now? Yes, like I think you should, so then if there's any issues that you need to rectify.
I have one.
Mhm.
I have one. It's actually the one that you and I talked about earlier, Nadia. I think a question that is not asked enough because we make assumptions about what terms mean is how much money do I need to close?
Yes.
What we ask all the time, what I get asked all the time is how much of a down payment do I need?
Yeah.
And that is not the same thing as how much cash do I need to close?
Yeah.
Why
It's
is it
not,
so damn much?
huh?
And why is it so much? Yes.
And
I
why
can
is it so
explain.
much?
Yes.
It's shocking.
Yes.
It's necessary, and a lot of that money is like actually yours anyway, and it remains yours to pay out. But so basically, the down payment is all right. Cool. I'm showing that I'm putting some of my skin in the game, right? So FHA minimum down payment is 3.5%. Conventional minimum is between 3 and 5%, depends on the client's profile. There's programs called Home Ready and Home Possible, which are conventional loans, which put you into a certain income bracket depending on your area, and those may help you to qualify for that 3% option. But usually, customarily, if you're doing the minimum down payment for conventional, it's 5%. Dang, I lost my train of thought. Oh yeah, so sorry. So that's the down payment. And then after the down payment, so that's that amount. So we'll just do easy numbers, $100,000, right? 3.5% of 100,000 is 3,500. So you think about that 3,500 that you have saved. That's not all that will entail in the entire transaction. That's not all you're going to pay at the end of the day. You will be paying what's called closing costs, which include transfer taxes to the state, appraisal fees, other taxes, escrows that we're collecting. And what's included in the escrows are your
Gil went through this recently, or about a year ago. So it's still very fresh.
wow. Your escrows.
I've on the 2 times in my life that I've purchased a home, the closing costs are probably the most frustrating thing, only because you have this number, and I think you have this number in your mind, right? So you start with, like you said, the 3.5%, maybe 5%, whatever your number is, and you're like, oh, well, okay, I got 20,000 in the bank, I'm ready.
Good.
And in speaking with my friends who are like looking to buy homes, my number in my head is always, listen, like you probably need 10 to 12% of the entire purchase price of the home if you're really going to be in that home. And I guess, one of the things I just asked you to speak to, is that something that really, someone mentioned the question about, different banks providing down payment assistance and things like that. You know, in our communities, I think that's something we often look for. You know, are these things normal? Where do we find them? Where do we look them up? How do we get a hold of them? How do we qualify?
Yeah, so you're asking me about down payment assistance? Yeah?
Mm.
Well,
Okay,
no,
yeah.
please continue, and whenever you get a chance, throw that in,
Okay.
because I'm sure it's something that I know a lot of people who buy homes are always really looking for, you know, extra money, because when you get in the home, you often haven't even furnished the home.
Exactly.
So you just got into the door, and you know, I think when I bought my home, the broker was like, okay, well, we want to make sure you have some extra money here and there, you know, so you're not, you know, basically house poor. But I don't
Yeah.
know if a lot of brokers do that for people. So I just wanted to, you know, any extra money or help you can get is helpful.
Yeah. Yeah. That's a great broker because I mean, I don't want anybody jumping into a home house poor and they've spent like all their funds, and you know, Murphy's Law would have it that something's gonna happen in the house and that you need to fix. So, you know, but yes, closing costs, and I was talking about the escrows, and the escrows usually includes your insurance, your property insurance. I mean, yes, your property insurance and then your property tax. And we collect about 12 months of that in the prepaid section of what's called the closing disclosure or the loan estimate. So it's first the loan estimate. And then when you get closer to closing, it's called the closing disclosure. That shows all the fees that you would have to pay in the transaction. And a lot of the stuff that we collect, because we have to collect about like, depending on the time of year you close, 11 months of escrows in your taxes, or 3 to 12 months in your insurance. So like it just depends on the time of the year that you purchase. This time of the year, you're going to pay a chunk of a larger chunk of escrow.
Can you speak a little bit more to that, the time of year that you close? Why does it matter if I closed in September as opposed to if I closed in January?
Yes, so the reason being is because taxes are collected every year in November, right? So taxes need to be paid out every year in November. And so the further we are away from November is the more taxes that we have to collect, right? So the cycle, and it really depends on what state you live in, but in Florida, right now, we are collecting about 11 months of taxes to make sure we have enough money in the escrow account. The escrow account is what pays out, you have a question, Gil, but what pays out your, okay, what pays out your
No question.
taxes.
I'm just in shock.
Yes, yes. It can be quite sticker shocking to some of my clients, and I am very transparent with them, especially in the loan estimate portion of things, which is the beginning when they say, all right, cool, I'm like ready to proceed. We look at their stuff, they find their property, and we're putting all the fees together. Yes, that portion can be a little bit shocking because that does take up a larger amount of your closing costs. It does. But it's really your money that you're paying towards taxes anyway. So you would have paid it now or paid it later. So, you know, it's not just going up into the air somewhere.
And Gil asked the question as far as choosing a professional. I think it's always worthwhile to take the time and meet the people who you're going to work with and find someone that works well with you, because it's great that you worked with a professional that had the empathy to understand and the willingness to teach and to explain to you and to be transparent with you, because sometimes in the profession, or in many professions, but definitely in this one sometimes, people are afraid of information because they feel like it may scare you away. Like, he's going to buy anyway. Me telling him all of this may just scare him away. So it's great to find a professional that is willing to educate you, is willing to take the time. We do not for the work that we do. It is part of that, of making sure that you better understand, because these are commission only jobs. I do not get paid if I'm just randomly muting. I didn't even touch it. We as realtors never see a dime if we do not, we as realtors, can you hear me now? Never see a dime if we don't actually close your transaction, and I won't see you next time if I didn't do a good job for you. So it is in my interest to be the best advocate for you that I can possibly be, in an effort to make sure that it ensures longevity for myself. So I'm really on, when you're choosing a professional, whether it's a realtor, whether it's a financial advisor, as we'll talk to someone next week, whether you're speaking to a mortgage broker, to make sure that you have someone who takes the time to really make sure that you understand what you're doing. Because home purchase, chances are, for most of us, it's the biggest transaction we'll ever make. It's the biggest financial that we'll ever make, and it's worthwhile to have, good.
I always say to my clients, like I say to them, rates could be very similar across the board, right? But you also have to know if you feel comfortable with that person. Like, if you're calling them, can you find them? Do they call you back? Like, think about those things. Don't allow people, just because they're doing the mortgage, that they can just treat you any kind of way. I've seen and heard, like, your mortgage broker didn't call you back in how long? Like, why is that happening? So don't allow those things to happen. Like, they are vying for your trust and your attention. So it's very important that if you are asking questions of them, that they're able to answer them. Or if they don't know that specific question, because sometimes we all have like unique things, that they're saying, all right, let me look into it and get back to you, versus just saying, oh, brushing you off. Make sure that they do answer your questions and they're transparent with you. The minute that they start being evasive and not transparent, then I don't think that's the person.
Indeed. Okay, two more. Let me ask you about two specific groups and two specific life events that may impact someone's ability to actually obtain a mortgage. One being divorce and the other being bankruptcy. Those are two big life events that I know people often face challenges when they're trying to move into that next phase. So if you can speak a little to how those two things, how you've seen those two things impact someone's ability to actually qualify for a mortgage, and what some possible solutions for people who have dealt with either, whether it's timetable or otherwise, what are some suggestions for them?
Yeah, so speaking on the divorce portion, since we are in the state of Florida, if you are considered legally married and you're purchasing a property, your spouse needs to be on that deed, even if it's just you on the mortgage. So
I want you to say that again before we move on. I want you to say that again. If I am purchasing a property and I have a spouse, I am purchasing it on my own. I'm buying.
Yeah.
Randomly muting, guys, sorry about that. If I am purchasing a property, even if my spouse, we're good? Can we hear again? I can't hear.
Do you have a Bluetooth that's kicking on or something?
Nope. Anything now? It randomly muted. I can't figure out. We're good now? Don't know why it's randomly muting. I want to make sure that I understand. If I am purchasing a property in the state of Florida, because as a state of Florida resident, whether my spouse is on it or not, they need to sign, they need to do what?
They need to sign the title documents, because you're still legally married. So people don't realize that separation, like legal separation, is not identified as not being married. You're still considered married. I've had people come to me and say, well, I'm separated from my spouse and we've been separated for a number of years, and I cannot touch that loan with a 10-foot pole until they have an actual divorce decree, that it's filed, everything is done and settled with the courts, so I can, go back and look through everything, and especially when my underwriting's doing due diligence, because we will have an issue. Your spouse will have to sign. And if you don't want them to sign, well, then we've gone through the entire process in vain. Yeah.
That's good to know. That's a very good point to know in our area. Now, speak to bankruptcy if you don't mind. Someone that has gone through bankruptcy, what are their, will I ever be able to buy a house again if I
Yes.
filed bankruptcy?
Yes, you will. The good news is, yes, you will be able to buy a house again. So you're not totally cut out from that. There is a time period you have to wait. We do have loans where you may be able to wait 1 to 2 years outside of bankruptcy, but the customary time is 3 years. Those 1 to 2 year options are more expensive, but if people have it and they've built it up and they're willing to jump into those loan products, they're not considered your conventional loan products. Those are available, but if you're looking to get into like a conventional option, then it's 3 years is your timetable at minimum.
So 3 years out of bankruptcy, I'll be treated, I won't be subject to the harsh penalties if it's been at least 3 years out of.
Yeah, and it's 3 years after the judgment date. So it can't be like, oh, I filed for bankruptcy on, I don't know, July 2017, but your judgment came through on July 2018. The clock starts on the judgment date.
Got it. Got it. Different subject. Can you elaborate a little bit on the difference between a mortgage broker and a direct lender?
Yes. So you could consider a mortgage broker being like your private mortgage shopper. You only have to pull the credit one time. So say if you work with me because I'm a mortgage broker, you only pull the credit one time and I pretty much do the shopping for you to find the best rate, the best product, the best company based on your situation. So like, for example, the best example right now, since we're in COVID, I have quite a few lending partners, right? But across the board, they're not treating all of the borrowers the same, right? So some are like, hey, you got to have a 680 credit score minimum. But I have other ones over here that are like, oh no, it's good, we'll take 640. So it really depends, and that's the benefit of working with a mortgage broker. But a direct lender, say like the PRMG or who else, Wells Fargo, and all those people are direct, right? You have to pull the credit with them, and it's only their products that you're looking at. They're not looking at the array of, so it's like coming to me is like going to a buffet. Going to someone else is like going to a la carte. And it depends on like what works best for people, but you know you're going to be able to find me as a mortgage broker. You'll be able to find me and talk to me pretty much majority of the time. You know, I'll call you back, I'll email you and let you know what's up. Yeah.
And you're able to share the various options. Okay, I'm going to circle back around. Gillian, if there are any questions in the chat or if you specifically have any questions, please feel free to jump in and chime in.
Okay, I will then read a couple in the chat. One question was, is it best around the fees? Someone asked, is it best for someone to buy cash? Will that reduce the fees? And then there's a second I'll ask after.
So cash won't necessarily reduce your fees from the tax standpoint, but it'll reduce your fees if you do have to pay what's called discount points for the rate that you receive based on your credit score. And we can like dive into that too. But it won't really change that much because it's a real estate transaction. These are customary real estate transaction fees that end up on your closing documents.
The flexibility that it gives you, just to speak a little bit, because that's the other side happens to be my where it's kind of my world. The fees that are associated with, if you have cash, I mean, you have cash. So of course, what it takes out are any of the fees that are associated with paying the broker, but it also takes out any of the fees that the broker requires. While it's not payment to the broker, it's still required by them in order to secure things. It's part of their checklist. So if the broker will require that you put money into escrow for taxes next year. Hey, if you're opening an escrow account, when you closed, I closed in July, that's where we are, I closed in July. I bought my insurance policy in July. Well, I have to put money on deposit. It's still my money, but I still have to deposit it into my escrow account in preparation for when the insurance bill comes around next year in July, so that there's enough money already waiting for that. If I buy cash, I mean, if you have the ability, and if I buy cash, I'm not required to make that deposit, but I am required to pay that bill when it comes around next January. So those are the things that may sometimes feel when you see it on paper and it says, man, this mortgage company's closing costs are $20,000. And if I buy it cash, I only have to pay $5,000 in closing costs. Well, really, it's not simply the mortgage's fees, because of course, yes, the mortgage broker has to get paid for their services. That difference is not simply fees that are being charged by the mortgage company. It really, a lot of it is just what it takes to actually set up that mortgage. So yeah, it may seem like it is less. And if cash is king. If you have cash.
But not in a mortgage transaction. I say that cash is not king.
Cash is not. Bank statements are king in mortgage transactions. Verifiable income is king. Go ahead, Gil, with your next one.
So the next question comes from Lysandra, and she said, can you address if someone doesn't have the down, and then I have a couple more questions after, but can you address if someone doesn't have the down payment, what steps can they take to set up a payment plan until you can reach the down payment amount and closing costs?
Well, I would say that's like based on personal preference, right? But you can do your own little like debt to income ratio calculation to see potentially what you might be able to afford, right? Then you can say, all right, I'm gonna make a plan. You know, I want to buy a house by next year, July. How much are you gonna save, and what's really sustainable for you, and how much you're making, and all that. It's really a personal thing there.
And I would just encourage Lysandra to go back and watch the previous videos with Amarel, where she really covered budgeting, saving, which will really help you towards your plan. So
get that online savings account where the money's gone, where you don't have to look at it and pick at it. But
so please, Lysandra, go back and watch the previous videos. Those might be helpful. I had another question. You know, a lot of times we don't talk about paying down the mortgage because it just seems like this massive number that we'll never get to, like 30 years, 40 years, 20 years. You know, what is your thought on actually paying more towards the principal? So, you know, let's say your mortgage is, I don't know, $1,200, $1,300 a month, and you're paying maybe an additional $300 a month. You know, what are your thoughts on that? Is it good to do that? Should you invest the money? I mean, any thoughts? And obviously some of that's personal, I'm sure, but.
Well, yeah, personal preference too. Like, you know, if they want to invest the extra 300 and, you know, double that, fine. But paying off that debt, yes, and making sure that when you do talk to your mortgage company, telling them that you want to put it towards the principal, because they will just, you know, tack it on wherever they feel like. So you just make sure you tell them, hey, apply this additional $300 towards my principal. Thank you so much. But yeah, I've seen where people may have a certain interest rate and maybe they don't want to refinance, right? Because sometimes refinancing might not make any sense for them. They don't want to pay those closing costs because yes, there are closing costs associated with refinancing. And so if it makes more sense for them to just keep paying more aggressively than to pay it down or pay it off quicker, then I suggest that that's fine.
Awesome. Another question someone mentioned earlier about HOA fees, but as we get to HOA fees, because obviously I know that can be a big, you know, a big purchasing high or low for someone and how much you can afford based on HOA fees. I'd also ask you to dive into PMI and what that is. What is property mortgage insurance? How can we avoid it? And one of the things I recently learned when I was buying my place is, you know, you can actually pay it off up front. Now, whether that's, you know, beneficial for you or not, I don't know. But if you can talk about those things a little.
All right, so I'll speak to the PMI, which is the private mortgage insurance, right? So PMI is when you pay less than 20% down. So I have a lot of clients come to me and their assumption is, oh, I can't buy a house because I don't have that 20% to put down. That's not the case. You can purchase, as I said, with less than the 20% down, but you will have what's called the mortgage insurance monthly. It's calculated based on a certain percentage of the loan amount. So it fluctuates and really depends. And usually that's just the amount that you'll pay until, especially if you're in a convention, I'm speaking to if you're in a conventional loan. So if you're in a conventional loan, you'll pay that amount until you get to that 80% loan to value, right? 80% loan to value means that you pretty much have 20% that's paid off between how much your house is worth and how much you have in a loan. So sometimes people will do an appraisal to see if their LTV, their loan to value, is increased or decreased, so that they can reach out to their mortgage company to tell them, hey, I'm within that 80% LTV. I need you to remove my mortgage insurance. Mortgage insurance, though, does stay on a FHA loan for the life of the loan. And at the closing, so this is another closing cost thing, at the closing for an FHA loan, you actually pay upfront mortgage insurance on the closing disclosure. At the closing, that's like your full year of upfront mortgage insurance that they collect. But then you have to pay mortgage insurance through the life of the loan in your payment. You did talk about HOA, and I do want to just like talk about the expenses and what goes into me looking at your debt to income ratio and seeing how much home you can afford. So it's a matrix, right? It really depends on what the taxes are doing, what the insurance is doing, and what the HOA is saying, right? Based on like how much you might be able to afford. So for example, say you can afford 300,000, right? But oh man, the taxes in that area are crazy, they're egregious. I'm not going to be able to afford it. It may kick your debt to income ratio out of whack. And that's when you have to say, all right, actually technically can't afford 300,000. We have to scale back a little bit because the taxes are too high in that area. So it's a matrix, like it just, you know, you got to say, okay, we can't go as high as this, and we got to stay within this amount. And so sometimes, because the taxes and the insurance can be so variable, I know that may be like a frustrating piece for some first-time home buyers, because they're like, but you said my pre-approval was this amount. And I'm like, well, I'm basing it off of the estimate. But when I actually look at the property, maybe like the property in Miramar is like super expensive. Like Miramar tends to have higher taxes. And
so
yeah.
One of the things, and I want to share on this because it's something that, you know, clients run into all the time. And more we're finding that it's necessary to have that education as early as possible. One of the questions you want to ask your mortgage broker when you receive your pre-approval is, would I still be approved for this if I have to pay an HOA, right? Yep. So if I am approved for 250 in the South Florida area, chances are, be super honest with you, chances are you're going to be looking at a townhouse or a condo. There aren't a lot of single family homes in the 250 and the under 300 range. It's just the reality. It's a tough reality, but it is the reality that it's not as prevalent here to actually find those prices. So if you're approved for 250 or 260, it may feel like, oh yes, I'll be able to shop and find something. But because you're most likely going to end up having to pay HOA, you have homeowners association, the monthly fee, you have to have that conversation with your mortgage broker about, but if I have to add HOA to this, will I still be able to, is there still enough room in my debt to income for me to shop for 250? And if there's not, if I add how much HOA? The other question, because this happens often also, is taxes. Nadia just mentioned taxes. So on my side, I see this a lot, and it's not always that the taxes in a particular area are high. And I don't want to take too long to talk on this. I think I will do a live later on at some point to kind of break this point down so we don't take too much time. Taxes in Florida on a property can vary. My taxes can be $3,000 and my neighbor's taxes are $6,000. And you're like, it's the same house, they're on the same block. Why in the world would the taxes be so different? One of the major reasons is that state of Florida has what they call, there's a cap on how much my taxes can go up on my primary residence. So if this is the house that I have lived in and I've lived here for 20 years and I bought it for $100,000 20 years ago, my taxes have only gone up by 3% every year for those 20 years. Mr. Jones next door bought his house 2 years ago for 400. And his taxes are based on what he bought it for. So there, we can be in the same neighborhood. So one of the questions you absolutely want to ask your agent, your realtor, when there's a property that you are interested in, is how much are the taxes and if there's an HOA fee, because those two things can absolutely throw everything apart. It can break everything apart. And we go back to Nadia and we're like, but you told them that they can shop for 400. Well, 400, and then there's a $400 HOA fee and $6,000 taxes. All of a sudden, you can shop for $250.
Yeah, I get a question where they're like, well, why do you put the HOA into my debt to income ratio? That's like a separate payment that I'm not paying the mortgage company. Yes, but that is your housing expense, and I need to know all the things that go into your housing expense to make sure you're able to afford everything, so you don't jeopardize the affordability of owning the home.
Exactly. Gil?
Nadia, a couple of things. 2008, obviously, when the crash came, it hit our community extremely hard. A lot of people went through foreclosures. A lot of people went through bankruptcies, which you kind of talked about. Some people did short sales. Can a person, and if you can give the term limits, or I'm sorry, the time limits, can a person who has gone through a short sale, a foreclosure, or an eviction purchase a home again? And if so, how long do they have to wait?
Yes, they can. I'm drawing blank on the amount of time. I don't want to just like throw out a number there. But I think it's about like 3 to 4 years. Yeah, I believe it's like 3 to 4 years. It's around the same as like the bankruptcy. Like it's not going to be anything like higher than that, really. But I did see like 2008. The reason why 2008 was really a thing was because it was the wild, wild west, you guys. People were just giving out loans. If you had a pulse, you were getting a loan. You get a loan, you get a loan, you get a loan.
Everybody.
Now it's much harder. And I think people who came from that era, I can tell, because they're like, well, why are you asking so many questions and, asking me for these documents? And I'm like, I don't make the rules, but if, you are who you say you are, or you're like telling me the truth, then it shouldn't be any issue for you to give me everything I need.
Let's get those documents. Gil, any more questions from our friends out on live?
Sure, there were a couple of questions in the live. Someone asked, is there a way to remove PMI without refinancing an FHA loan? And then there's another question.
No, FHA, it's through the life of the loan.
That's what I said, I thought so.
So you'd have to refinance. Yeah, that's what they asked you to refinance it.
So I do tell my clients, like, they're like, okay, we're ready to buy. And I say, okay, you're an FHA candidate. And they're like, we don't want the PMI at the end of the day. I'm like, hey, you can just refinance, just like improve your credit, improve, what got you to do the FHA, and you're improving your debt to income ratio, then just refinance into a conventional loan so you can do that 80% loan to value.
So someone else asked, and then there's another question, and we're going into time, but there's so many questions. It's such a big topic.
I know.
So someone else asked, why are there fees when you're refinancing? Why are there closing costs when refinancing? And I'll add something to that, because can you roll your closing costs in to the new loan? So one,
Yeah.
why are they? And I'll add a second piece. Can you roll those closing costs into the new loan?
Good
So
questions.
answering your question, yes, you can roll those fees into the new loan. And the reason why there is closing costs is because you're assuming a new loan. So we're basically paying off your old loan and you're assuming an entirely new loan with new terms and a new rate. So it can be 30 years or less than the 30 years. Usually the intention, if you're doing a refinance, you're really trying to improve your rate and your term. And so it's basically a whole new mortgage that the state and everybody else has to re-record into the documents. And so that's why there's going to be a cost. There's going to be fees because they do have to collect that amount for the work that they're doing. But sometimes clients, if you're going conventional, you can waive your escrows. And what that means is we won't collect your escrows at closing and I won't collect any prepaids, and that will reduce the amount that you pay in closing costs at the end of the day.
That's helpful. One other question, and this is more personal. My boss at one point, and he's in his mid to late 50s, when he initially purchased his home, he had, I guess he got into this product, which in essence allowed that if something were to happen to him, the home would have been paid off, right? And he said when he refinanced this, he lost that completely, unbeknownst to him. You know, obviously maybe not reading the fine print or no longer being offered. Is there anything out there like that? Because a lot of times what happens is in our communities, we experience, gentrification begins moving in. Someone offers someone a big payout, they sell their home and leave, and maybe there might have been room to leave it to a descendant. So do things like that exist where you can purchase a product that pays off your home and leaves it to your descendant should you experience mortality?
So I don't do any products like that, but maybe somebody else might be able to speak to it. But to me, that sounds more like, yeah, so Amaral, yeah. Sounds more like a life insurance type thing. But Amaral, if you wanted to speak to that, because I don't do any of those.
It's so interesting that you asked this today. My office, I would sell State Partners Realty. If you are a realtor out there, you should be with Sell State Partners Realty. They educate us on so many great things. Like they just really are always bringing things to the table. And today during our office Zoom meeting, this is a product that I'll go back a moment. I used to be a banker. So I started my financial career as a banker with one of our big institutions. And this was actually a product that institution would offer. I really think it was called the Payment Protection Plan. It was a product that we actually offered for our, we were a direct lender for our products. We actually offered this. I haven't seen it. I think that it does exist in some places. I had not seen it in years since leaving them. And just today, during our office meeting, our broker brought to us a life insurance company that actually has such a product. I'll have more information next week because they're actually coming in to talk to us next week, but that does have such a product. I'm a big fan of such a product that is tied to, if something happens to you, the biggest debt that your family has is your mortgage. It's something that I feel is worthwhile, especially if you're a little bit older. Not to say that, mal existe, terrible things can happen every single day to you at whatever age, but it's, I love that question, Gil, because I think it's a really great product. And I'll take the opportunity and share possibly next week, because next week we're talking about retirement. We're talking about how to protect our assets next week. So hopefully by then I will have a lot more detail. So come back for that. But I do think that that's something that's important. So we're going to get back to it.
Exactly. That's why I was saying it does sound like more like a life insurance product than what I would offer. But that's, yeah, I agree too. It's something amazing because it's such a large investment we're making and, keeping it on.
How are we on time, Gil? I'm using my phone, so I can't see the time right now.
Sure. We are an hour and 15 in. I'm sure that people will give you more time because they're very much tuned in, but it's totally up to you.
Get my light.
So what else do we have for us from the live, Gil? Any more questions from our audience?
I think we'll ask them, we'll poll them once more to see if they're asked. Some of the questions were covered in last week, so some people have been directed to that.
Awesome.
I guess one question, Amrel, you being a realtor, and obviously Nadia, you being a broker, so many people struggle with the decision whether to buy or keep renting, right? Especially in a city or in an area like South Florida, Dade, Broward, Palm Beach counties, which can be extremely excessive. Nadia, you mentioned the salary component earlier, not necessarily getting us to where we need to. What are your thoughts on that? Our community struggles mightily with that. So I'd really love for you guys to speak to that at least before we go.
So I will say this is not really a mortgage related thing, but say if you do work for someone, really negotiate your salary. I do know that a lot of the times in our community, we don't tend to negotiate our salary as much as we should. And I would say that's probably the first line of protection for us is negotiating your salary, or if you've been somewhere for a while, it's time to renegotiate your salary to make more. I think sometimes we're afraid to do that. And I just, your income is something that's going to take you far. Your income and your credit score will take you far in the home buying process. So.
I am a huge proponent of owning the space that you occupy. I'm a huge, and I'm realistic, especially being in the community and in our markets. I'm realistic that it's not something that's easy for everyone to do out the bat, but I'm a huge proponent that it should be on the agenda. It should be one of the things that we're working towards. The very first live that we did for our wealth building series, we talked about what our parents were able to do. I look back at the fact that in the 80s and 90s, our parents were making $3.45, whatever minimum wage was. Look up minimum wage in 1989. There were many people in our community, many people here in South Florida that are making that kind of money and still through sacrifice figure out ways to do it. I still think it's a huge opportunity. There is the two things that I see right now, especially during COVID, that there is freedom in ownership and there is protection in ownership. The huge renters crisis that's going on right now with people having experienced job loss and being laid off and everything that's going on as a result of the pandemic, renters are on the forefront. They are up front. The people who are going to get run over and actually going to get the most hurt up front are our renters. Even if what you own is a 2-bedroom condo, it is yours, even if you have a mortgage on it. The very first wave, they came out with all of these options to help owners defer their payments for 6 months, defer their payments for X number of months, even if it's forbearance. This will keep a lot more people in their homes longer. I think I told the story on one of my lives a while back about when the real estate market died. I was a realtor. And so when the real estate market died, my income went with it and it was a huge struggle. And as a result, wasn't able to make my mortgage payment. Honestly, that went on up and down, not really, because once you get a month or two behind, catching up is how. So you just it went on for probably 2 years, maybe a little bit longer. If I was a renter, I would have been homeless. But as a result of owning, and the bank tries to find ways to work with you, that doesn't mean that that's what you aim for, but there's a certain level of protection. So I'm passionate about this one, so I get a little bit long-winded. There's a certain amount of protection. Even if what you're buying is a condo, your first purchase is not your last. A lot of times we want to buy the house as the purchase. Young and coming up, new couple, we're starting out together, whatever your life circumstances are, your first place is not your last place, but owning it and then using that to buy something else later on as our income grows, our education grows, whatever. There's steps to this, there's levels to this, and it's okay to start where you are, but I am definitely team ownership.
Yes, and the bank doesn't really want to own your property. So that's why they will work with you. So as Emerald said, as long as you don't evade, and this goes for like any of your debtors, like don't evade. I think people like actually do want to try to help you. The things that I've seen where, if you do need help with your mortgage, they will tack on anything that you've missed at the end of your loan. And I've done some refinances for folks where it was a second mortgage or like a silent second mortgage on the back end of their primary, but we end up paying it all off. So they know, okay, I don't have to worry about that little mortgage that was back there put on by FHA or whomever to help me to get out of forbearance. So there's options.
And just one last thing, I was so excited. I just sold a friend of mine, I just sold their townhouse, and the girl who bought it is like 24. Super excited. I was super excited that she bought her first place and what that means for whatever comes next for her. So I was on the other side of the transaction, but I was like celebrating for her. So definitely.
Yeah.
So a couple of questions. I know we're winding down. Because South Florida tends to be so expensive, many people, their entry into their first place is a townhome or a condo. And after 2008, FHA loans, at least in South Florida, most of the buildings were not able to qualify under FHA loans. Recently, I believe sometime last year, that changed, where now you can have an FHA loan, even if the building isn't fully insurable, but a certain unit can be. Can you speak to that a bit, Nadia? Because I know, for our community, whether you're getting into a senior place that's 60,000 or your first place that's 150 or 250, that sometimes is a lot more attainable than a $400,000 home. So if you can speak.
Correct. So yes, in October of last year, they did what's called a single unit approval for the FHA. The only issue with that is that some condo associations don't want to fill out the specific FHA condo questionnaire. Is that ethical? Probably not. But also dealing with these condo associations, sometimes it's an uphill battle with them. But as long as the property meets the criteria, and it's like a number of things that must happen, a number of boxes that must get checked in order for the FHA single approval to happen with a condo. But there have been times where, like I was working on a transaction, trying to do the FHA single unit approval, and they did not want to fill out the document. It would have met the criteria, but they didn't want to fill out the document, and I didn't have time to sit there and wait. I had to get this loan closed, so we went conventional.
So we're winding down. Gil, do we have any more questions as we wind down?
Yes. Someone asked about the difference between streamline refinance and a normal refinance, and if there are any benefits. And this is something that I'd never heard of the term.
Yes.
I love our audience. I do. I love them so much.
Okay, so a streamline, you cannot wrap the closing costs into the loan. That's one of the major differences, right? Your expectation is that you're paying your closing costs out of your pocket, but you also don't have to pull a full credit report. I can pull a mortgage only credit report, make sure that you've been paying your mortgage on time, and then do the streamline that way. But the consumer just has to know you're gonna have to pay for your closing costs out of your pocket. It can't be wrapped into the loan.
And can you is that something that someone can ask for? Like, hey, I want to look at a streamline refi, or yes?
Yes, and there's a streamline refi also for VA. So it's for VA and FHA, they do streamline. But VA, I can wrap it into the loan.
Okay, but generally with the streamline, you will have to pay closing costs out of your pocket.
Correct.
And you cannot do a conventional loan for a streamline, is that correct?
No, streamline is only FHA. Okay. So if you're going to do conventional, it'll just be like a traditional FHA. I mean, a traditional conventional refinance.
Got it. So with the streamline, you will now incur PMI unless you're coming to the table with 20% again?
Nope, life of the loan. FHA is life of the loan.
Correct. So with the streamline, you will again incur PMI.
Correct.
If you're
just-
over 80%.
Huh? Say that again?
If you're over 80%.
Nope, FHA, life of the loan. So like you
No,
pay,
period.
period, over the whole life of the loan.
Hmm.
Yeah.
So if I refinance, if I have an FHA loan when I purchased my home that and it was, and I had PMI on it, and now I want to refinance and my loan to value is below 80%, I'm still paying PMI to FHA?
Yes, FHA is over the life.
I just learned that.
Conventional is, yeah.
I
Uh-huh.
did not know that.
It used to be different, but they changed it. So it's over the life of the loan. After 2008, it's over the life of the loan.
Period.
And I think that's something, Merle, and you saying that a lot of people don't know. The concept is after you hit that 80 LTV, you can it drops off if you request it. So I think for our community, a lot of times we are getting FHA loans because there is a higher income, that's an income ratio allowed. So as a result, they don't tell us that component, or we're not looking, whether we're not told or we're not looking. But that PMI, if you're paying for the life of the loan, let's say you're paying $300 a month, that's $3,600 a year, 30 years, that's $100,000.
Yeah.
So
I do mention it to my clients, but I do tell them like, hey, we're going to be on this FHA loan right now because we need the DTI to match your income and your debt, but come back to me in a couple of years, especially when you have more equity. Hey, Malcolm, more equity in your property.
Malcolm.
Nadia, let me ask you a question before we go. This is really important for a lot of people. What is a really comfortable amount? Because obviously you being able to pay up to 50%, let's say you earn $4,000 a month, right?
Yeah.
So if you can qualify to pay a mortgage of $2,000 on your $4,000 income, that's tight, right? No matter how we look at it, that's tight.
Very tight, yeah.
So what is something that you would recommend to your friend? What would you recommend for Nadia, for yourself?
Yeah, I don't want to go above really 40% DTI on the back end, which is like your full pizza pie, right? And I always say this in terms of pizza because I think a lot of us eat pizza, right? Because if you think about like as a whole, that's your income, the whole pizza, and then you slice in half, that's the debt. You need to have some of the pizza left over for other things that come about. They don't want it to be too tight, and so I say like 40% or below is ideal. But some people, if they're applying for a loan and maybe it's just themselves, and I know they have the spouse, but the spouse isn't on the loan, then I will say, all right, cool, we can do higher because I know the spouse has income, but maybe their credit wasn't so great to put them on the actual mortgage.
And does that 40% include everything? Or is that like, should that be your total payment, taxes, insurance, HOA, all of that?
That includes everything, including the other debts that I saw on your credit report as well.
Got it. So your recommendation is no more than 40.
Yeah, like you want to just try to stay as low as you possibly can, living within your means pretty much. I don't really want people to like stretch all the way to the top. I will tell them, I'll say, hey, my professional opinion is this, but you at the end of the day do make the choice. However, I don't think you should go higher than this. I'm very conservative in the way that I predict and guesstimate on what the taxes and the insurance and all that stuff will be from the beginning.
Full disclosure, I'm a cheapo, so when we bought our house, we were doing 18%.
That's good. That is great.
Because that means you can afford to live the rest of your life.
Yes. You don't want to be like, I also tell people this, yes, it's other people's money, so it is a segue, right, into wealth building, but you also don't want to feel burdened by this mortgage payment or whatever other debt there might be. So just be mindful, like you don't have to do this as a show for anybody else. It's for you, like your shelter. And also, as Emerald said, like your first property more than likely won't be your last. Like build upon each one. Take the first one and then it becomes a rental property. Like, all of that. Oh, I do want to say something too. So like conventional, right? I do have people sometimes say, well, I want to figure out and how to invest in real estate and what needs to happen. So if you qualify for like an FHA loan, just know you have to live in that property for 1 year as your primary residence. Some people may tell me otherwise, I don't know, but you have to live in there for 1 year as a primary resident.
I know we're winding down. This is really hard because we have so many good questions.
Good.
One question is, a lot of times folks look to build. So can you speak to a construction loan if folks are looking to build? And then the second piece is, you mentioned the investment component. So if someone is actually, they own a residence, right? They have a mortgage on it and they are now renting it out, right? So it's rented, they can show documented income every month. Can they go and qualify for a new mortgage without this current place affecting their debt to income ratio?
Good.
Yes. So the first question you had was
Construction loan.
construction. Yes. So construction to perm loans are available. They do have a certain criteria. They're a little bit more strict than, say, just buying a new construction or a resale. And sometimes it's done in like 2 separate loans, or it can be done with a loan that's construction, takes you through the construction. After the inspection happens, then it will convert to a permanent, and that's what you'll pay going forward. I could dive into the guidelines for that, but that's like, wow, would take a long time to talk about. But the other thing you asked about was the investment piece. And so if you have a property and you're wanting to buy a new property and you want to use whatever amount you're making from that previous property, yes, you can use that to help you qualify for your next property. You can also use, say if you're buying a duplex or a triplex, you can use what might be the rent, like the projected rent for that property, to actually qualify for that current property. So there are ways, and we do calculate what the potential expenses are in the way of, the taxes and the insurance, to know how much income we'll extract from that property to use towards your other property or towards that duplex or triplex.
That's awesome.
Awesome
That's
tidbits.
really helpful. Thank you so much, Amrel. Whatever you want, I've checked the chat. We have a few questions. The last one, I guess we'll take for the evening.
We'll take that.
Is for using 401k for first-time buyers. How does that work? And I'll just inform everybody that'll be our last question.
All right, sounds good. So at the beginning of the process, I can actually take just your 401k statement to know that you have that money in there. You don't have to necessarily liquidate it until we get further down into the process. So you don't have to, I try not to bog down my clients with too much to do. But I do tell them, like, hey, if you are going to use these funds, just get ready with enough time. Talk to your 401k company, see how long it takes to liquidate whatever amount of funds it is, and see how they're going to send it to you. More than likely, they should send it ACH, so it's quicker, seamless. You don't have to wait for the check to come in the mail, because I don't know about you, but sometimes the mail is not reliable. But yes, I can use the 401k. And so for some people's 401k, if they ask them and they tell them that they're using it to buy property, I know there won't be a penalty for some. So it just really depends on your 401k servicer. And so I do tell my clients, just like, do your research on what your servicer is able to offer you and see if you're not going to get a penalty when you pull out that money towards your 401k.
and make sure that they code it as such when you pull it out. Make sure they
Correct.
code it so that when you get that 1099 at the end of the year, that it's reflected as such. And keep in mind, you're not going to, even if you can avoid the penalty by
Yeah.
having it coded as such, but you still have to consider it as income
Yes.
for that year. So if you took $30,000 out of your 401k and in that year you earned $50,000, you now have income for that year of $80,000. But what you save yourself by it being coded as being used for the purchase is the 10% penalty that you would have had to pay otherwise. But you still have to, it is still going to impact your bottom line. But if those are the funds that you have,
Exactly.
welcome to home ownership.
I
Yes,
just want,
but go ahead.
I just wanted to add, if you ladies could both type your information into this chat. Amrel is not only a board member, she's a realtor. She's being very modest, but please reach out to her if you're looking for a home, if you need assistance, if you need some guidance. She's always willing to help. And I'm sure Nadia also, Nadia, you do mortgages throughout the state of Florida, any county?
I do throughout the state of Florida.
So if you both could put your information in this chat and I'll funnel it to the Facebook chat, please.
All right, sounds good. Sounds good. So Nadia, thank you so much for answering the call. When Avasansum called, you graciously and with a smile said, yes, I will definitely come out and share with the people. And I definitely think that the people enjoyed and that we're better off for it. Now, it's a complex subject. It's a lot. We wanted to at least give you a snippet as far as those that are here with us, whether you're on the Zoom or whether you're on live. We wanted to definitely at least give you a snippet, and hopefully the little bit of information that you were able to glean from our time together will serve you in being able to ask the best questions possible when you're in the real life situation of dealing with a mortgage broker. And hopefully they are as kind as Nadia has been to us. And we'll continue doing what we do. I love this platform. I love how dedicated our board members. Gil is on our board. Gil is not just our help us with the questions person who is definitely has been a great support week in and week out, but he's on our board, and we are just, I'm just super proud of Avasansum and of Sandra Dennis, our president, and everyone who is a part. So please like Avasansum's page. We are on Instagram, we are on Facebook, and we are dedicated to bringing you just great information. And hopefully this was just, a little snippet. If you're new to our community, you'll see that this was just a little snippet, and we're dedicated to the community. So thank you for taking the time with us tonight. Thank you, Nadia. Thank you everyone who actually came out and hung out with us. And please share this video if you have a friend that's thinking about purchasing, if you have, or that just has questions. We're definitely be happy to be circulated around. All right.
Yes, thank you so much for your time. Thank you everyone for your questions. I really love this. This is my passion, as I said. And I left my email in there and my phone number, but email is always the easiest way to reach me and get like comprehensive answers, because I will answer you back if you have questions. So, thank you.
Sounds good. And with that, good night. If I tech person, because I'm on my phone.